Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Friday. It is January the 10th. We're almost midway through January. And I wanted to do a follow-up video to the last three that I posted last weekend and give you a little bit of insight into my energy portfolio in terms of how it looks today. But I also want to talk about everything else, right? So many people ask me, what about the Magnificent Seven? Do you also invest in other stocks? What do you do with the rest of the market? Like, where do you put money when it's not in energy? So I thought I will share some of that information with you and maybe it provides some assistance to someone in terms of the decisions that you might have to make. So the first thing I did was I went to Google, which is, of course, a paid for propaganda site of the United States government. And if you don't believe me, yeah, every time you use Google Maps, just remember that the Google Maps were created by the Department of Defense of the United States government. Anyway, I went to Google and said, energy images, show me stuff, right? So this little screenshot that I grabbed here basically shows you what energy looks like according to Google. So energy does not exist unless it revolves around wind turbines, solar panels, or photovoltaic panels, etc. Now, I can tell you with absolute confidence and total conviction that I will invest in all the products that are used to manufacture these things that you see on the screen here, right? So all the petroleum products, plastic products, and silicon products, etc., that are required to make photovoltaic or solar panels, wind turbines, etc. Even the cement processing and the manufacturing of blades and the rebars that are used to reinforce the platforms that are built. I'd invest in anything that is related to that rather than invest in the so-called renewable energy systems themselves. One of the main reasons for that is that the renewables, as we know them, are traditionally hopelessly inefficient and ineffective. And in addition to that, you had to literally destroy the environment in order to build a solar panel farm, right? So these things are unsightly. They don't work for me. And I'm more than comfortable investing in the products that are used to manufacture the renewable energy products. So let's take a look at my portfolio. So, okay, I'm off my high horse, right? Let's get back to the fun stuff. So this is a pie chart of my portfolio in terms of what it looks like if I include everything that's sort of energy, excluding small caps, because I have a couple of small cap stocks that are not listed or included in this pie chart here, right? So you can see I have a position of almost 30% in energy transfer. And then the rest is sort of a combination of a balanced portfolio, except that some of them, like XLE and Alliance Resource Limited Partners and Enbridge, is slightly larger than the others. The odd one out here is uranium. So when you look at Cameco as a uranium company, you could say Cameco is a miner rather than an energy company. But of course, uranium is the feedstock for nuclear energy. And that's why I included Cameco up here as well at almost 7% of my energy portfolio if you include one miner. So in order to be a little bit more pure, let's take Cameco away, and then you can see the numbers slightly shift. So energy transfer now becomes almost 30%. XLE is up at 18%. The new positions that are open in the past week, Exxon and Phillips 66 are at around 7, 8%. And then I have Lockwell here. And the reason why I'm highlighting this one is because the United States government has imposed some sanctions on me for invading another country. And as a result, when I look at my brokerage statement, the Lockwell entry on my brokerage account statement says no number or no CUSIP, and the value is zero. Now, my broker has informed me that my Luck Oil shares have been moved into an escrow account, but I'm not allowed to have them because I'm currently under sanction. So in reality, I can't count Luck Oil, which is quite a large percentage of my energy portfolio. It's almost, almost 9% of the value of my energy portfolio. So I have a few thousand shares of Luck Oil. It's currently trading at about 6,900 rubles, approximately, which is about $70, right? So those have just been kind of removed from my energy portfolio because the current value is zero. And I'm not sure why the United States government is so angry with me. Probably because I opened up this presentation by saying Google is spreading US government propaganda. But that was just a joke. Come on, man. Cut me some slack here. Anyway, if I had to look at the portfolio then and exclude Lockwell because I can only count cash that's in the cash register, then my Exxon and Phillips 66 positions, which are new and just opened this past week, moved to around 8% or so. So I circled them in green because they're new. Alliance Resource Limited Partners is around 14%. Enbridge is 15%. Energy Transfer now hops or goes right up to 33.5%. And for Energy Transfer, I've been long for over 3 years with a cost base of about $8. Thanks to Bulldogs number one for that initial recommendation for me to look. And no, really look, Mr. Oxy at the time, I was buying Occidental Petroleum for like 10, $12. And Bulldog said, no, you have to look at Energy Transfer. So I did, and I bought it. And here we go, right? So a few years later. And then XLE at the bottom at 20%. The reason why I'm circling XLE at 20% is because XLE is my parking lot, right? So if I have spare cash, which is cash awaiting investment, I park it in XLE, and I'm talking specifically energy here. And then what I'll do from time to time, as I did this past week, is take some money, some cash out of XLE. So I'll sell some XLE, hopefully at a profit, because no one gets poor when they sell something for a profit. And I'll take the cash and invest it into stocks like Exxon and Phillips 66, where I think there's some upside in the single stock, even though there's also obviously commensurate risk with holding single stock as opposed to holding the ETF, which is much more diversified. But anyway, that's where the cash comes from, right? So now you can see if I had to rebalance some more, because let me just go back for a second. At 20%, I still have 20% of my cash sitting in XLE. If I had to rebalance, which I won't do today because I've only owned these two stocks for less than 1 week, Exxon and Phillips 66 are stocks that I would potentially put some more money into. If they pull back, if they go up, then I'll just leave it as it is. And that cash will come from XLE and move into Exxon and Phillips, which will give me some rebalancing here, because now you can see they almost are equally weighted in my portfolio, or in terms of my pie chart, as you can see it sort of on the left side of the screen here. Then XLE has dropped from 20 down to about 11, but you'll see that I left Energy Transfer as it was, right? So then you can quite rightfully argue and say, well, is this actually rebalanced because I have a very large position in Energy Transfer? Well, Energy Transfer has been my superpower in my energy portfolio over the last 3 years or so. As I just mentioned a minute ago, my cost base is about $8. It's currently trading at almost $20. And in addition to that, it pays me a nice dividend. So I have no plan to sell or exit Energy Transfer anytime soon. In fact, I do pretty much the same thing with Enbridge as well. I've been long Enbridge for years, and that one pays me a dividend of about 7% as well. So if I had to rebalance, the money would come out of XLE. I'll leave Energy Transfer alone and rebalance on the other side of the ledger, right? So at a quick snapshot, I'm rebalancing, but I'm not, right? Because I want to hold on to my Energy Transfer perhaps for another 2 years or so before I do anything at all. We call that a concentrated position. Now, my Energy Transfer position in total, the blue over here, you can see at the top of the screen is a legend. It says gain or loss. So my Energy Transfer is up over 100%. Now, very often what I do in a situation like this is I might sell half of the stock, which means I'm taking all my own cash off the table, right? So if you bought something for $100 and it goes to $200, then you're up 100%, right? And then if you sell half of it, you put $100,000 back in the bank and you still own the other half of the stock, right? So then you're playing with the house's money. So that's one way for me to potentially exit Energy Transfer, but I'm not planning to do that right now. I'm just telling you how it could potentially work. And on the next couple of slides, I'll show you how I actually did that in practice. But in addition to the fact that it's up over 100%, it also pays me a dividend, as I mentioned, of around 6.5. XLE, it's up about 33 overall in my position in my portfolio. It pays a dividend of about 3.5 or so. Enbridge pays a dividend of 6%. It's also green for me, or blue on this particular bar chart. Alliance Resource Partners is up quite nicely. And in addition to that, it pays me a dividend of more than 10%. You just got to watch out for Alliance Resource Limited Partners like Energy Transfer. These are limited partnerships, so they're going to issue you a K1 because you're a partner in the company. And then it will complicate your taxes a little bit when it gets to tax season or tax filing. And then you can see my two newer positions because they're just like sort of less than 1 week old. My gain is 0, right? I just bought them. In fact, to be fair, Phillips 66 after today's carnage on the market might be down 4%, but it also pays me a dividend of 4%, which means it could be a bit of a wash. Of course, the dividend is on an annualized basis, so I don't want it to pull back too much, but it does give me a bit of a hedge, right? So if the stock pulls back 4% and I earn a dividend of 4%, then it's a wash. On the other hand, if the stock, let's say Exxon goes up a bit and it pays a dividend of 4%, let's say just for the sake of example, if Exxon goes up 6% and I get a 4% dividend, I'm up 10%, right? Mathematically speaking, if you can earn 15% per year, you can double your investment portfolio every 5 years. But that's kind of a quick snapshot of my energy portfolio. And even if I had to rebalance, I would rebalance on this side of the ledger and leave the energy transfer alone for now. It's good. I have a large gain on it, so I don't need to necessarily do anything with it at all. Why XLE? Right. So this is a snapshot of the top 10 holdings in XLE. So XLE is an ETF, which is an exchange traded fund. And this one is managed by Spider or State Street. Down at the bottom on the left, you can see almost 74% is represented here in the top 10. And in that top 10, it's 22% Exxon, 15% Chevron. These two guys used to be 2020. They increased their holdings in Exxon and decreased their holdings in Chevron, which means the fund management team at State Street like Exxon much more than they like Chevron. And then at the bottom, you can see it also includes Phillips 66, right? So when I hold the XLE, I'm actually holding more Exxon and more Phillips 66 anyway. The reason why I circled Schlumberger is because sometimes on the channel, when we chat in the comment section, which by the way, I appreciate, and you'll notice that I respond to as many of them as I can. Sometimes people say, what about Schlumberger? Wouldn't you buy a Schlumberger? And sometimes I say, no, I wouldn't buy it, not even with your money. Now, to be fair, if that sounds a bit harsh, I actually do buy it because I buy XLE and it includes a little bit of Schlumberger anyway. So if I sound critical or harsh in terms of my commentary related to a certain stock that you might like for whatever reason, there is a chance that I own it as well. I might just own it in an ETF as opposed to owning it outright or directly. The reason why I wouldn't buy it directly might be something else, and that's something we can discuss in a separate chat on the comment section. But people say, what about everything else, right? Or do you only invest in energy? So like, no, the energy portfolio is just one piece or one part of my investment portfolio. And then the rest I manage pretty much in the same manner too. Now, from a foundational point of view, I'm looking for dividend stocks. And what I mean by that is I have some small cap stocks in my portfolio that don't pay dividend at all. And those are high risk stocks, and especially if they're small cap stocks as well, right? But those are also the stocks where you could potentially get a 5x, 10x, 20x return on your investment. So I have a few of those as well. I'm not talking about those stocks here. I'm only talking about the larger foundational stocks. I'm always looking for stocks that pay a dividend. So I went back to Google, my friend, and said, what about dividend stocks? Show me a picture. And they show you a whole variety of different images that you can click on, including very cool websites like Investopedia, where you can learn a whole lot of stuff if you need to. But you can see the little images here, right? These are dividend paying stocks. From a foundational point of view, large positions I hold, I always park them into dividend stocks. And the objective behind that is to say, as a general rule, um, the Dow as an index for well over 100 years, almost 150 years, has generated on average about 6% per year. And if I can also generate a dividend income of around 4%, that's 10% per year. What I'm aiming for is 15. If I can get that 15%, as I said, I can double my investment portfolio every 5 years. That's just math. It doesn't matter what you hold, right? So you might only get one stock that gives you a 20x, and other stocks could be down and you're still up 15%. It's very, very possible. And at 15%, you can double every 5 years. Of course, you could also get lucky with stocks like Nvidia or Tesla or whatever. I'll talk about those in just a second because they included in the Magnificent Seven. What does Vanguard hold, right? So VYM is an ETF like XLE, which is a State Street ETF. VYM is a Vanguard ETF. And this particular ETF here is a broad market, high dividend paying ETF. At the bottom, you can see these stocks, the top 10 stocks, only represent less than 25% of the holdings. So you can see how broad-based the actual holdings of VYM is. And these are great companies, right? And I've circled a couple of them here, and I'll come back to this blue arrow in just a second. But the companies like Johnson & Johnson, I don't really want to invest in pharma at all. There are a few reasons why. I mean, like, I don't really want to invest in the pharmaceutical industrial complex. And in addition to that, right now in the United States, with Robert F. Kennedy Jr. potentially becoming the HHS secretary, there could be a little bit of trauma felt by the pharmaceutical stocks. And right now, I'm not a comfortable person holding long stocks of the pharmaceutical industry in general, right? One can also argue that these stocks are somewhat philosophical in terms of whether you want to hold them or not. Many of the things that they do are unethical, uh, regardless of the fact that they're meant to sort of promote and encourage healthcare. They do a lot of harm. In fact, if you look up the largest fine ever paid by a U.S. domiciled corporation, um, the Department of Justice website will show you that the party who paid the largest fine ever was Pfizer, right? So I don't really like pharma in general, but some of the pharma stocks pay a nice dividend, and for that reason, they're sometimes worth holding. Bank of America is a stock that is one of Berkshire Hathaway's favorites. Bank of America did very well for Warren Buffett, especially last year. It was up quite a lot. I wouldn't buy Bank of America, not even with your money. But as I said, it's done well for Uncle Warren. What I would buy is JP Morgan Chase. But now, of course, I need to also trade within my little sort of sandbox that I just explained to you in terms of my ETF and rebalancing. I can do the same with VYM and individual stocks that are included in VYM. And for the sake of this example, let's look at JP Morgan Chase. So here I have one of our accounts. And this particular one account had a concentrated position in JP Morgan Chase. And it was very easy math, really, because going back just a few months to October 2024, in this one account, I sold 130 shares and basically kept 130 shares, right? So I sold half the stock. So if you're up 100% and you sell half the stock, that means you've taken your own money off the table and you're playing with the house's money, which means the rest of the JP Morgan stock, so the 130 down here, is basically free stock, right? So whatever the investment was, it went up 100%. I sold half of it, took my cash back. I can park it in VYM and sit on the cash awaiting investment for a while. And maybe if JP Morgan pulls back, I can even buy it again. But the reason why I did that is because I was up 100%. And by taking half of the stock and liquidating half of the position, I take my own money off the table and leave the house's money to run and grow over time and do whatever it does, including pulling back. I'm not too worried about it because it's not my money, it's the house's money, but I've earned it because I took the risk of investing in that single stock to begin with. What about the Magnificent Seven? So some people have actually asked me and said, did you miss out entirely, or do you not play entirely in the sandbox that includes the Magnificent Seven? Because I never really talk about direct holdings of companies like Amazon and Google and Tesla, etc. And that's because I don't really hold them directly, but you can play this in almost exactly the same manner that I just shared with you. So I'll be very brief here, because what happened here was you have an S&P 500 index. And I'm going to use SPY as an example, but let me just show you what the actual outcome was of this Magnificent Seven's return on investment for 2024. Yahoo Finance reported, and right at the bottom of the screen, there's a hyperlink that tells you where I'm pulling this from. And it says the market could surge higher even without the Magnificent Seven tech stocks' massive outperformance continuing in 2025. But here's the rub, right? So through 3 quarters of reports for 2024. The combination of Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and Nvidia grew earnings year over year by 33% in 2024, compared to just 4.2% growth for the other 493 S&P 500 companies, right? So of the S&P 500 companies, the Magnificent Seven generated 33% as a return on investment and growth, and the other 493 combined averaged just 4.2%. Now, I just told you a minute ago, the Dow has been performing at over 6% per year for more than 150 years. I need the performance to be at 6% or above, plus the dividend on my foundational stock. So it's great if you were invested in one of these stock as a single stock like Microsoft or Nvidia or whatever the case might be, and you benefited from it. It's fantastic. Congratulations. Well done. The other way that you can play it is to hold SPY. So SPY is another spider ETF. And this particular ETF, you can see the top 10 stocks here in the ETF. And down at the bottom, it says almost 40% is represented here in the top 10 holdings, and you can see what they hold. So you don't know, right? Nobody knows whether it's going to be NVIDIA that's the outlier, or maybe Broadcom, right? Because these things are the same, but they're not. So just on the right-hand side here, you can see on the semiconductors, NVIDIA year to date, which is just 10 days, is up 4%, while Broadcom is down 1%, right? So these things are the same, but they're not the same. But you can buy SPY, you can buy the entire ETF, and you can play it in the same manner as I've just shown you what I do with XLE or VYM. These are great stocks, they're great companies, and they should be good growth, especially in the semiconductor sector or sub-industry as we go along. Most of these stocks are technology based, and at the bottom I highlighted Berkshire Hathaway because it also invests in technology because Berkshire Hathaway's largest position is actually Apple. So by buying SPY, I actually get a little bit of exposure to Berkshire Hathaway as well, which means I get a little bit of a little slither of Warren Buffett's genius brain to help me with my investments. But SPY is not a bad stock to hold, and quite an easy pickup as well because it gives you exposure to the Magnificent Seven plus some others. So these are sort of concepts of rebalancing and maybe how I play different market sectors and different sub-industries within those sectors. And then, of course, I talked a little bit about rebalancing, which is realigning the weightings of a portfolio to its original asset allocation by periodically buying or selling assets. Now, sometimes when I sell stock, I might sell a stock at a profit. I did this quite a number of times with Occidental Petroleum, where I bought the stock for like, $10. And when it was trading at $60, $70, I sold some for a profit. Remember, Uncle Warren's average cost basis is just below $60, but my cost basis was about $10, right? So if I had other stocks where I was running at a loss, for instance, like Devon Energy, I could sell some Devon at a loss and sell some Occidental for a profit. That's called tax loss harvesting, which means because I sold one stock for a profit and another stock for a similar loss, it's a wash. So I don't incur a tax liability. I'm just rebalancing my portfolio. I do that from time to time as well. But for the most part, my foundational stocks are buy and hold stocks. I buy them and I very, very seldom sell them, except for the fact that I move money, for instance, from my parking lot, like XLE, to a single stock or single stocks like Exxon and Phillips 66 when I think the time is right for that stock to start picking up again and maybe reversing course after it's been beaten down quite a bit. So that's kind of how I roll. That's what I do. I hope this is helpful to someone. Thank you for watching. Take care and enjoy your weekend. Bye bye.